Hey everyone, Antonio here with Everyday Tone. Let's continue our discussion on investing in the stock market. The stock market is a place where you can purchase ownership in public traded companies. In order to purchase ownership in a company, you need to use a brokerage firm, which is a platform that allows that transaction to happen. A few examples of brokerage firms are TDAmeritrade, E-Trade, Vanguard, Fidelity, and Robinhood, and many more. Before selecting a brokerage firm, make sure to pick one that fits your investment needs. One investment need that comes to mind is fractional shares. What are fractional shares? A fractional share is a fraction of a share. For example, if you go to a restaurant and there is an expensive bottle of wine that you would love to try out, but it's too expensive. So your next best option is just to try a glass of that wine. That is a fractional share. Another thing that comes to mind when selecting a brokerage firm is what are some of the types of accounts that you can open? You can open non-retirement accounts, retirement accounts, education accounts, and custodial accounts. Let's discuss what a non-retirement account is. Standard investment non-retirement accounts. Let's start with individual accounts. Individual accounts are the accounts that most people open whenever they start trading, investing, stuff like that. Who can use it? Anyone can open this account, but there can only be one owner. How much can you contribute to this? There are no contribution limits. You can contribute as much as you want. $10, $5, $1,000, $1 million, whatever it is that you select. Are there income limits? There are no income limits. When can you take the money out? You can deposit or withdraw to this account at any time you'd like. If the account owner dies, the asset gets passed on to his or her estate. Now let's talk about joint accounts. Joint accounts are great for married couples. They want to open an account with both their names in it. Maybe brothers and sisters, cousins, friends want to pull their money together and invest together. That's when you would open up a joint account. So you need 2 or more adult owners. Mind you, if one of the owner dies, the other owners have the rights to the entire account. Now let's move on to individual retirement accounts, also known as IRAs or IRAs. Don't confuse IRAs with your company's 401k or your company's 403b or any other kind of retirement accounts your company may offer. This is completely separate. So let's start with traditional IRAs. With a traditional IRA, you can contribute money pre-tax, meaning that you can contribute any money before it gets taxed. So that's a great tax benefit. The money will eventually get taxed once you retire, once you start taking the money out. Anyone who has earned taxable income or their spouse has earned taxable income can open up a traditional IRA. In 2021, you can contribute up to $6,000 a year in total among all your IRAs, or $7,000 if you're 50 and older. For traditional IRAs, there are no income limits. You can start withdrawing money from your traditional IRA after you're 59 and a half without any penalties, or unless you have any qualified exemption. If you need to take money out before you're 59 and a half, you have to pay a penalty, which right now the penalty is 10% plus whatever taxes you may owe on that. Okay, now we have Roth IRAs. Money contributed to Roth IRAs are post-tax dollars. The great benefit of this is you pay the taxes now, so whenever you retire, all the money you've contributed and its earnings, you pay no taxes. Anyone who has earned taxable income or their spouse has taxable income can have a Roth IRA. Again, you can contribute up to $6,000 a year among all your IRAs or $7,000 a year if you're 50 and older. So if you have a traditional IRA and a Roth IRA, in between both IRAs, the max you can contribute a year is $6,000 or $7,000 if you're 50 or older. With Roth IRAs, there comes an income limit. So you must earn $198,000 a year or less if you're filing jointly, or $125,000 a year if you're filing single. You can start withdrawing money from your Roth IRA the same like a traditional IRA at 59 and a half with no penalties. but you need to have the account open for more than 5 years to withdraw any of the earnings. So if you're 56 years old today and you open up a Roth IRA, you have to have the account open for at least 5 years before you can start withdrawing any money on the earnings. Earnings meaning money that you've gained from the money that you put into it. So one great benefit about the Roth IRA is any of the contributions you put into it, you can withdraw that at any time. Remember, you already paid the taxes on it, so you don't pay any taxes on it if you withdraw money that you've put in. Example, if you put in $1,000 and that money grows to $5,000, you can pull out that $1,000 without any penalties because that is the contributions. Some people use Roth IRAs as their emergency fund. So let's say you have a $5,000 emergency fund and you put it to your Roth IRA. Some people, instead of leaving that money into a savings account where you barely make any interest on that money, what some people do is they invest that money in a Roth IRA, but that also comes with risk. So that $5,000 can turn into $10,000 or it can become less than $5,000. So it's up to you how you want to do a risk. But that's a great play. You can put your money to work for you. Let's discuss educational investment accounts, also known as 529 accounts. These accounts vary from state to state. Anyone can open up a 529 account. You can open up a 529 account for your children, and you can contribute up to $15,000 per year per beneficiary to these accounts. The money grows tax-free as long as the withdrawals are used for qualified educational programs. Some qualified educational programs are college education, K through 12, private schools, religious schools to pay for educational needs such as fees, computers, books, etc. If withdrawals are used for non-qualified educational program, there is a 10% fee. I've seen some parents use these accounts by sharing the account's information with their friends and families, and every time their child or themselves have some kind of birthday celebration, Christmas, they ask for a small donation. Any donation of $10, $20 really helps out in 18 years. The compound interest on 18 years at $10 a month or $20 a month, $100 a month really adds up and can really help pay for college education. Or if you know your child is going to go to a private school, you could put money aside when they're born so that whenever they go to these private schools, you already have the money to fund it. Now let's discuss custodial accounts. Who can use it? Any adult can open an account on behalf of a minor. All assets are transferred over to the beneficiary at the age of termination, oftentimes 18 to 25, depending on the state. There are no income limitations for these accounts, and there are no annual limits of how much you can contribute. The money can be taken out at any time as long as the withdrawals are used for the minor's benefit. Some people also use these accounts as educational accounts, but don't confuse a custodial account and an educational account. The educational account has the added tax benefit. The earnings grow free in an educational account. Whenever you withdraw money from the custodial account, taxes are applied depending on the minor's tax rate. This is another great account to open up whenever your child is born because you can add a small amount of money from age of 0 to 18, and once they're 18 and they inherit this account, they can have thousands, if not millions of dollars, depending how much you put into it. Now you selected a brokerage firm, you open up an account. The next thing you have to do is fund the account. That means deposit money into that account. Once you deposit money to that account, you can use that money to purchase stock. Now that you have your account open, let's start investing.